Hello everyone, my name is Shakti Vilan. I am from the Department of BCom Business Process Service at PSG College of Art and Science, Coimbatore. Hello all. Define your risk and design your reward. Unlike direct stock trading, options give you the power of flexibility. You can protect your portfolio, speculate on price movements, or generate consistent income. In this session, we will explore what options are, how they work, and understand the key option Greeks that shape every trade. Let's begin this journey into smart trading with option. The next, an option is a type of derivative contract. It gives the buyer the right but not the obligation to buy or sell an underlying asset. On the other side, the seller carries the obligation if the buyer chooses to exercise that right. The underlying assets can be stock, an index, a commodity, or even a currency. Options are always linked to a specific strike price, an expiry date, and a premium that the buyers pay. They are also traded in lot size. When we study options, we focus on key components like the strike price, expiry, premium, lot size, option Greeks, and the concept of minus. In simple terms, option allow us to design trade where we can define our risk and structure our reward. And the next heading is type of options in buyer perspective. Options are mainly classified into call option and put option. A call option gives the buyer the right to purchase the underlying asset at a fixed price known as a strike price. The call buyer make a profit when the market price goes above the strike price. The maximum loss is limited to the premium paid. Call options are usually preferred by traders who are bullish, accepting the price to rise. On the other hand, a put options give the buyer the right to the sell the underlying asset at the strike price. A put buyers benefits when the market price falls below the strike price. Here again, the maximum loss is only the premium paid, but options are best suited for traders who are bearish, accepting the price to decline. The next one is type of option, seller perspective. Now let us look at option from the seller's perspective, also called the writer. A call seller is like a person who promised to sell shares at a fixed price. If the buyer chooses to buy, the seller collect the premium upfront as income. If the market price goes higher than the strike price, the call seller faces unlimited losses because he has to sell at a cheaper rate. But if the market price stay the same or fall, he keeps the premium as a profit. So a call seller usually accepts that the price will not go up. The advantage is immediate premium income, but the risk is very high and theoretically unlimited. And then a put seller, on the other hand, promises to buy shares at a fixed price if the buyer want to sell. Here also the seller collect the premium upfront. If the market price falls sharply, the put seller suffer a big loss because he must buy at a higher price than the market. But if the market price stays the same or goes up, he keeps the premium as profit. A put seller usually accepts that the price will not fall. Again, the benefit is immediate premium income, but the risk is large if the market crashes. Now let us understand the concept of moneyness in option. First, in the money. These options already have intrinsic value. If you exercise them immediately, you get profit. For a call option, ITM means the spot price is greater than the strike price. For a put option, ITM means the spot price is less than the strike price because they already carry value. The premium includes both intrinsic value and time value. They are safer to buy but more expensive. Next, at the money ATM. Here the spot price and the strike price are almost equal. At the money options do not have intrinsic value, only time value. These are most liquid and heavily traded strikes. Both call and put ATM options usually carry the highest time value premium. Directional traders generally avoid ATM, but straddle and strangle traders prefer it for strategy based trading. Finally, out of the money, these options have no intrinsic value, only time value. Exercising them gives no profit. So if nothing happens, the expiry worthless. For a call option, OTM means the spot price is less than the strike price. For a put option, OTM means the spot price is higher than the strike price. OTM options are cheaper to buy but very risky as they have a high chance of expiring worthless. Still, traders buy them for speculation, hoping for big move in the market. Thank you.